why are we doing these webinars? Well, as you know, it's been an extremely volatile, realistically starting partway through the fourth quarter of 2021 and definitely into the first quarter of 2022. So we wanted to, our portfolio management team and our advisors wanted to give a bit of an update here on two things, a detailed market update that Elvis will be presenting, and then a bit of an investment policy statement update that I'll go through later after Elvis is finished. Then we'll stick around for some Q&A, but we encourage you to ask your questions as they go in the chat, so somebody can help you help answer those right away. It's a fun little slide of our team. Just so everyone knows, recently Aaron, John, and Za all achieved their portfolio manager licensing, so we'll be updating all of that. So Ryan Smiley, I believe, as well, will have his shortly. We've also just brought on another associate advisor whose picture's not there yet, but Vincent Zhang has joined our team as well, and we're really happy to have him as another associate advisor. So there's a lot of firepower backing you up as clients right now. This is a legal disclaimer that they make Elvis and I put on every seminar that we present, which basically I think is just IA saying it doesn't matter what we say. These aren't their opinions. Now, these will be nowhere near a Spotify Joe Rogan kind of comments or that Z95 DJ that recently just got fired from his job. These are more just our market commentaries and our philosophies for you. So what are we going to talk about today? Well, we're going to have Elvis start out with an update on our portfolios and an update on the investment markets. And then I'm going to talk briefly about what that all means specifically for you in regards to your investment policy statements, which dictate the asset mix that you've got, the eggs that are in your basket, and the risk that you're taking on.
Well, thanks everyone for joining us on this webinar. When I put together the material for this presentation, it was about a week, 10 days ago, shortly after listening to a geopolitical strategist who was the keynote speaker for the CFA Society of Vancouver's annual dinner in the last week of January. Now, geopolitics is a very broad topic. It includes demographics, economics, politics, security, and so on. This speaker, his name is Peter Zehan. He did full justice to the topic, combining facts and figures that highlighted the dangers that face the world now and in future. But here's the thing. Hasn't the world always been a dangerous place? Sure, there have been prolonged periods of peace and stability over the last 100 years. But at any given point of time, there's generally some crisis or the other happening somewhere in the world. So rather than focus merely on the dark clouds, especially at this point in time, I thought let's look for the silver linings as well. And that's the topic of my presentation. Now, here's a quick recap of the dark clouds that are presently front and center for most people. Firstly, COVID is still here, and in fact, we will shortly be entering year 3 of the pandemic. Last year, we saw the emergence of the horrific Delta variant, and more recently, Omicron, which fortunately has not been as deadly. But now, we also have to deal with vaccine politics and the terrible polarization that is being caused by it all around the world. Secondly, the markets and the economy. January was the worst month for global stocks since the pandemic sell-off of March 2020. In fact, it was the worst January in many months, in many years, for the S&P 500. On the subject of economic uncertainty, that has also been growing thanks to rising inflation and the near certainty that interest rates are going to be rising around the world very soon. And if that's not enough, we've got the geopolitical situation to worry about. And these worries currently center around the Russia-Ukraine situation in Europe. So you might think, where's the silver lining in all this? But look, here we are. Drum roll, please. With regard to the pandemic, it's very likely that sometime this year, the pandemic will be in the rear view mirror, beg your pardon, because of a combination of higher vaccine rates, rising immunity, and new treatments like the Pfizer pill that has already been approved for use in Canada. On the subject of the markets, a great deal of the froth that was a feature of the markets about a year ago has now been wiped out. Having been in the markets for the last 25 years, I can tell you that the craziness we were seeing in SPACs and cryptocurrencies and meme stocks was really disconcerting. It was getting to be as bad as the dot-com excesses in some respects, and we all know how that ended. Also, the markets were freaked out about rising rates in January, and this kind of sentiment keeps going up and down. Today, for example, the 10-year bond yield in the US and in Canada was up by 10 basis points in response to a very strong inflation print from the US, and the market sold off. But if you look at it from the glass half full point of view, the fact that central banks like the Bank of Canada and the US Federal Reserve are finally poised to ratchet interest rates higher means that they have confidence in the economic outlook. And the numbers bear this out. Our economy, the US economy, the global economy is on pretty solid ground. On the subject of the geopolitical situation, that's a wild card, unfortunately. But let's hope that better sense prevails in Russia and Ukraine, because the last thing anyone needs on the heels of a global pandemic is a full-blown war. The pandemic actually is the latest in a long list of shocks over the past 1/3 of a century, the last 33 years, starting with the collapse of the Iron Curtain in 1989, and then the rise of China in the 1990s, and then we had 9/11, we had the wars in Afghanistan and Iraq. And these shocks are only part of the story because they all fall in the sphere of geopolitics that I mentioned earlier. In addition, on the macroeconomic side, we've had three major bear markets in the last 20 years. You had the tech wreck, you had the great financial crisis, or GFC, and then most recently you had the pandemic panic in March and April of 2020. Given that this is a pretty long laundry list, what do you think markets have done in this time frame? They've actually been up relentlessly to new highs. We say that the market needs to climb the proverbial wall of worry to do well. And this is something the market has excelled in over the last 20-25 years. Over the last 33 years, since 1989, the S&P 500 has returned about just over 11% annually, and the TSX and the MSCI World Index have returned about 8.5%. So if you look at the chart, the blue line is the S&P, and the orange and green lines are the TSX and MSCI World Index, and the yellow line is Europe, which has been lagging for quite a while now. So terrific returns from these 3 or 4 major indices or major economic blocks. The other takeaway here is that dividends really help. Since 1989, they make up a full 1/3 of total returns for the TSX and the MSCI World Index, and about 20% for the S&P 500. That figure is probably a little lower for the S&P because of the big contribution of tech to the US economy. And technology stocks, as a rule, generally don't pay high dividends. They invest mainly in growth. So the bottom line here is, headlines come and go, but you need to stay invested over the long term. And Robert's going to go over this with some compelling numbers later on in his presentation. Now, there's tons of research to support the philosophy of staying invested for the long term. For example, if an investor misses, only the 10 best trading days in a full decade, in 10 years, portfolio returns shrink a lot. Similarly, missing the 10 worst days will improve portfolio returns quite a bit. The problem is that the best and the worst days follow each other quite closely. So timing these moves is nearly impossible. I'll give an example. Just a week ago, US stocks had the best 4-day advance since 2020. And this rebound came right after the worst monthly performance since March of 2020. And when you look back to March of 2020, those dark days when we didn't know anything about the pandemic, we just knew that there's this big, massive shock, this big pandemic bearing down on us. No one could have foreseen that the markets would hit bottom on March 23rd of that year and then actually double over the next couple of years. So that's a problem with market timing, extremely difficult to do. So looking at a recap of 2021, we all know, exceptional year for stocks, without a doubt. Most major indices were up around 20% or more. In this particular graph, the blue line represents the S&P 500. The orange is the MSCI World Index. Green is the TSX Composite. And yellow is Europe's Eurostock 50 Index. So all the major indices were up about 19-20% or more. Terrific performance. For the TSX in particular, it was the best performance since 2009. And that's because two of our biggest sectors, financials and energy, they had runaway gains. Energy rode the back of a really strong rally in crude oil prices to be up 42% for the year. And the financials, the banks and insurance companies, of which we have a great number of great companies in Canada, that sector returned 32%. On the US side, tremendous gains too. Because of the contribution from the tech stocks, the US was a standout performer. Interesting fact, in just the 3-year period from 2019 to 2021, the S&P 500 has doubled on a total returns basis, and the Nasdaq has actually gone up 142%. Now you're seeing quite a bit of those gains dissipate over the last month or two, but we'll get to that in a few minutes. Next slide. So how did our model portfolios do? They actually did really well. Our flagship pension and Canadian dividend models both returned over 11%. Our pursuit growth model was at 14%, and the high growth prosperity model did about 21%, or a little over 21%. So some of those gains were retraced in January, as you can see on the right-hand side. But even so, because the portfolios are so well diversified, on average, we had about half the volatility of the broad markets. So I know Robert and Aaron and John and Ryan keep talking about this, but in a diversified portfolio that's got a good mix of stocks and bonds, you're going to get about 60, 65, 70% of the upside. But more importantly, you'll get about 50 to 60% of the downside. And that's really critical because capital preservation is extremely important. Capital preservation is key to ensuring that our portfolios do well over time because it ensures that we can bounce back from market declines. So in terms of the biggest contributors to performance, just for the sake of simplicity, we'll use our pension model as an example. That particular model has about 160 million in assets, and I know many of you clients own it. The biggest contributors to performance last year was the Invesco S&P 500 Top 50 US ETF, which has been a holding of ours for many years. We had a couple of Canadian REITs do really well too. We also had US stocks like CVS and Qualcomm Excel, and a number of Canadian stocks like Westshore, Loblaw, Nutrien, Shaw did really, really well. On the negative side, detractors were led by the Invesco Clean Energy ETF, which was a disappointment. And stocks like Barrick Gold and Disney that fell out of favor last year. But you know what? We're not pulling the plug on those stocks. We've sold the Invesco ETF for most clients, but for Barrick Gold and Disney, I think they are great long-term stocks. We are in it for the long haul, and we'll talk a little bit about Disney later on in the presentation. Now, what does the economic outlook look like for this year and the next few years? We always look at the IMF's World Economic Outlook report because it's a fantastic synopsis of growth prospects around the world. It's also reasonably accurate. So their conclusion is that global growth will slow down a little bit, to be expected from the big rebound that we had last year, but it's still pegged to come in at a solid 4.4% this year. So very solid growth. On the earnings front, and remember, this is what really drives market indices, stock market indices. Corporate earnings are actually forecast to reach record levels this year. They hit a record last year too, so another new high this year, and they expect it to grow by about 9% for the TSX and the S&P 500. So really strong corporate profits, which should drive the market higher. Inflation, without doubt, has become a problem, but I do think that it's quite possible if pandemic concerns recede, the millions of people who are currently out of the workforce may return to work, which would help keep inflation in control, and supply chain pressures may ease as well. Now, bear in mind that one of the big unexpected effects of the pandemic was that this sheer number of people who have left the workforce, and it's incredibly difficult to get good people to join a business. But in an environment where inflation is 5 or 6% and government benefits have fallen off, I think many people will have no choice but to go back to work, especially if there's some sense of security that the worst of the pandemic is over. So I believe these pressures, these factors may help keep inflation in check further down the road. Now note also that although the markets have been spooked by the prospect of rising interest rates, markets usually do quite well at the beginning of a rate hike cycle. So the table on the right shows you the performance of the S&P 500 over the last, I think, almost 70 years, when bond yields also rose quite sharply. And the average return over these 15 periods was 26%. So quite good. Now, why is this? It's because central banks generally start raising rates when the economy is booming. And during such times, stocks outperform bonds by a wide margin. But central banks are also quite cautious about hiking rates aggressively because they don't want to cause an abrupt slowdown and a possible recession. That's the last thing they want. Now, both the Bank of Canada and the Federal Reserve are forecast to raise rates at least 4 times each this year. But even that total increase of, say, 1% barely takes the benchmark rate back to neutral territory. So I think it might be next year or 2024 before we begin hearing talk that the central banks are being too aggressive in raising interest rates. I mean, they cut interest rates for a reason, because the global economy was on the brink of collapse thanks to the pandemic. But now that you've been in a rebound mode for the last 18 months, there's really very little reason to keep rates low at these artificial levels. So in response to this scenario of robust global growth and rising interest rates, we made a number of portfolio changes in the second week of January. And the main thing we did was we boosted exposure to the energy sector and to the financial sector, because these are the two sectors that benefit the most in this environment. As you can see from the chart on the right, if you look at, this shows year-to-date returns up to Feb 7th for the TSX. Energy, doing really well, up 15%, financials up 6%. On the flip side, look at information technology, down by 25%. That's largely due to a single stock, Shopify, which dominates the Canadian tech space. We also added, so these are the changes we made to client portfolios last month. We added a dividend ETF that goes with the ticker symbol PDC. It's one of the best performing dividend ETFs in Canada. It's got a 50% weight in Canadian banks and insurers and about 20% in energy producers. We also increased our allocation to US banks through the XLF ETF, and we also increased our weights to TD Bank and Manulife, and both of those are up over 10% so far this year compared to a gain of maybe 1% for the TSX. So we also sold a couple of holdings, and this is how we get the money in your portfolios for these purchases. Sure, when you guys send money in, we deploy that as soon as you can. But in many cases, we don't want to wait for that money to come in. And this is what rebalancing does. And we'll talk about this a little later. Through the rebalancing process, we sold a full position in a Canadian momentum ETF called WXM. We also took some profits in the XLG ETF. And as mentioned, we sold the Invesco Clean Energy ETF in most models except the SRI, or socially responsible investing portfolios. Let's spend a little bit of time on what I call a rebalance refresher to give you an understanding of this key process. So rebalancing means a process of realigning in asset weights in a diversified portfolio to bring them back to target. So what rebalancing does is it sells positions that are above the targets we have set. These are called overweight positions, and uses the proceeds from these sales to buy underweight positions or positions that are below target. This process, it forces us to stick to our discipline, not just make moves because we've taken a fancy to something that we like. It's a very, very disciplined process. Now, what do we mean by assets? In investment of financial assets, there are just three core groups: equities or stocks, fixed income or bonds, and cash. Everything else you can think of is a hybrid of these three. For example, preferred shares have some features of fixed income and some features of equities. So do REITs. So as a simple example to demonstrate the rebalancing process, consider a $100,000 portfolio that has only two holdings. And let's say we've set the target allocation at 60% stocks and 40% bonds. So this $100,000 portfolio has 60K in an equity ETF and 40,000 in a fixed income ETF. Now, what happens if the markets drop 10%? And let's assume that the equity ETF that we hold tracks the market very closely, right? When the markets drop 10%, usually fixed income stays about the same, or it might even go up a little bit. So the market falls 10%, the equity ETF is down 10%. That $100,000 portfolio is now down to 94,000. Okay, but because fixed income is at 40K, it makes up about 42.5% of the portfolio, whereas the equity ETF now makes up about 57.5% of the portfolio. So they are off their neutral weights by 2.5%. So let's say we rebalance. What happens? We end up selling about 2,400 of the fixed income ETF, and we use that money to buy the equity ETF. So now your fixed income ETF has gone from 42.5% to 40%. The equity ETF has gone from 57.5% to 60%. So with a portfolio value of 94,000, it's perfectly in balance. This is a very simplistic view of the rebalancing process. What we do is a little more involved because we've got multiple sleeves, as we call them, and they hold stocks, they hold ETFs, they hold mutual funds. But the basic process of what we call rebalancing back to target works like this, and it works extremely well. The two most common questions we get from clients are, why do you use fixed income at all when rates are already so low and are going to rise? Isn't that bad for fixed income? Why not just use cash? The answer is that fixed income, it's a fantastic portfolio stabilizer because it offsets big equity declines. Now, over the past 20-25 years, we've become conditioned to central banks stepping in and cutting interest rates aggressively when things look really bad, like they did in March of 2020. So when this happens, the fixed income part of a portfolio may actually appreciate, offsetting some of the decline in the equity component. Also, most fixed income instruments are marked to market constantly, so they reflect changing market conditions. This is very unlike GICs or fixed deposits, where money is typically locked until maturity. Now, fixed income is a very broad area. It includes a whole bunch of things: government bonds, corporate bonds, provincials, floating rate instruments, securitized debt, and so on. The fixed income pool that we have, called Steadfast, uses sub-advisors for these different components. A diversified fixed income portfolio like Steadfast can actually give you yields of 3.5%, compared with cash, which will give you 25 basis points if you're lucky. Final point, this fixed income securities are also very liquid, so they're a great source of cash when rebalancing. Now, how often do we rebalance? We rebalance at least once a quarter, but more frequently when markets are choppy, like they were in March of 2020, when we rebalanced maybe 3 or 4 times in the span of 3 or 4 weeks. We also rebalance contributions every Thursday, or more frequently if necessary. And if you send in a large amount of cash, like 50,000 or 100,000, we'll probably rebalance it right away, put it to work as soon as we can. Let's quickly look at what we call our rebalance criteria. Now, this is just a set of rules that we use to guide our rebalance decisions. For example, we rebalance if the TSX or the S&P 500 change by more than 7.5% from a previous rebalance level, or if they hit a new multi-year high or low, or if they breach something called a moving average, the 200-day moving average. That's more of a technical thing and hardly ever happens. We also rebalance if multiple stocks are up or down more than 15% from the initial target, or if an individual stock is up or down more than 20%. So the point is that this process reduces the risk of our emotions getting in the way of deciding when to rebalance, and it eliminates the risk for us of waiting for the right time to rebalance or invest, because, as I said earlier, this is impossible to pinpoint. There really is no right time. Now is the best time. Quick example here of our rebalance criteria. So we last rebalanced your portfolios on January 13th when we made those changes that I just described. And at that point, the TSX closed just under 21,300, and the S&P was at about just about 4,650. So based on this, on a rebalance criteria, and if you take a 7.5% you apply the 7.5% rule to this, we would rebalance if the TSX gets to 19,700 on the downside, or the S&P 500 gets to 4,300. On the upside, we would rebalance if the TSX gets to close to 23,000 and the S&P to about 5,000. So if the markets fall to those levels, rest assured that we would be selling fixed income, preferred shares, maybe selling alternatives, and we'd be buying stocks and equity funds like a platinum growth fund. On the upside, if we rebalance if the indices go back to those record highs, we'd be taking profits in equities and we'd be buying fixed income. So speaking of the platinum growth fund, let's spend a couple of minutes on this one. This was launched in November of last year. And the good news here is that it has been on an uptrend recently, as growth stocks have recovered to quite an extent. Also, as we've mentioned on a number of occasions, Platinum is a diversified fund of funds run by great managers from top-notch firms like Fidelity, Dynamic, AGF, McKinsey. So we view any dip in this particular fund as a buying opportunity, and we have been adding to positions. One point to note is, because the stock and ETFs tend to be very value-oriented, they're full of stocks that have good valuations, but perhaps not the greatest growth prospects. Platinum complements this value orientation extremely well. We also are monitoring Platinum's funds. It's got about 9 funds in there. We're monitoring it very closely. We'll make changes as warranted. Just a quick point on growth stocks. When people say growth stocks, you automatically assume it's technology. But when it comes to tech, this is a sector that's also incredibly diverse, lots of different areas in there. And bear in mind that the stocks that have been hit the hardest in this tech correction over the last 6 months are the ones that ran up the most in the last couple of years, despite not having profits. The fund managers and Platinum don't hold too many of these speculative stocks. They focus on the bigger names like Amazon, like Alphabet or Google, like Microsoft, which have held up much, much better than the smaller cap stocks. So just a point to note. The final slide, I briefly mentioned growth and value stocks. Here's a case study of how we pick stocks and how they complement the rest of our portfolio. Netflix has been a stock market favorite for many years, and you've all heard of the FANG thing, then in there stands for Netflix. But it's been in a pronounced slump since November. The last earnings report from Netflix was a sore disappointment for investors because expectations were sky high, but the company did not add as many subscribers as expected. So as a result, the stock is now down 33% year to date. Disney, on the other hand, launched its Disney Plus streaming service just as the pandemic hit. So the rapid growth in that service offset the losses that Disney had from its closed theme parks and cruises, etc. Yesterday, Disney was up almost 9% in after-hours trading after reporting a really strong earnings report. And right now, it's close to break-even on a year-to-date basis compared with a 33% loss for Netflix. A question I would ask you is, which one do you think will be the bigger beneficiary as economies reopen? Are people more likely to binge watch or continue binge watching Netflix? Or are they more likely to go out and do the things that they couldn't do for the last couple of years, like going to Disneyland or taking the kids to Disneyland or taking a cruise? The answer is quite obvious. Analysts have an average price target of $190 on Disney. I think today it closed at about 154 or 155. And I really think we could see $200 on this stock over the next year or two. So that's a 25% to 30% upside from here. We followed a very similar philosophy to some of our best performing stocks like CVS, like Qualcomm, like Visa, like Disney. These stocks have a great combination of growth prospects and relatively lower valuations. Now, I think I've gone a little bit over the time allotted to this presentation, but I'd encourage you to ask any questions you have in the Q&A session. And with that, I'll turn it over to Robert. Thank you so much.
So what do we need to talk about here with regards to the markets and this volatility? As Elvis has pointed out, this has been a very volatile time, definitely starting since November. We're dealing with rising interest rates, decreasing earnings valuations on some of the major markets, especially the NASDAQ. Consumer expenditures were falling, and they probably will continue to fall as inflation increases and bites into their spending power or puts more pressure on how much money they have to allocate to debt versus consumption. There's been a huge amount of volume in the put options market, and this is people basically buying protection for their portfolios against further decreases in the stock markets. Obviously, a lot of global macro events. I read somewhere this morning, an ominous thing about Putin moving blood and food supplies to the front line in the Ukraine. We have the other things we know, supply constraints. You might have dealt with that in the short term. Try to buy a new vehicle, or try to buy a new vehicle that's actually an interesting new vehicle, and good luck getting it. COVID keeps changing its ways, even though a lot of places, as we're looking at recently, both in our own domestic country and internationally, are starting to open up again. So what's there not to be scared of? Well, this is the rule, okay? You set the rule. The rule of how you have your money managed is set forth originally when you became a client, and everybody should have one of these. It's called your investment policy statement. You dictate to us what level of risk you're willing to take on. Now, remember, this investment policy statement dictates the minimums and maximums for equity or stock market exposure that you can have. keep in mind a few things from a goals perspective. If you've got $1 and you might want all that dollar back in the next 3 years, it should be in your bank account or in a high interest savings account. The funds that we manage for you as your portfolio management team and as your advisors are not for the short term. Okay, you can get them back whenever you like, but you shouldn't think of them as having a time horizon under 3 years ever. Because if you say, I've got $1, what should I do with it? And the first question we're going to ask is, well, what's it for? Oh, I might need it next month to buy a new vehicle. Should stay in the bank. The next thing you have to think about with how we're managing your money is, what is the maximum short-term loss that you can accept? Now, this is a tricky question because it's very emotional. I usually say, what's the biggest drop you could accept without changing your strategy? Most people change their strategy at precisely the wrong period of time. Remember that in a portfolio, you're going to lose money on a monthly basis a third of the time. How much money you lose a third of the time monthly depends on your level of exposure to the overall markets. Annually, you're going to lose money 25% of the time. So we reinforce terrible behavior, don't we? We send you a statement every month. We should send you a statement once a year with the caveat that says this. Once a year when you open this, okay, 25% of the time you're going to be mad. How mad? Well, you're not going to lose as much as the markets go down, but you will still be down. The other thing you want to do with your investment policy statement, and this comes to building your financial plan with the team, is figuring out what level of income we need to send you. If you've got money in this bucket, are we turning on the taps? Are we sending you cash flow every month? That will dictate what level of risk or variability you're comfortable with. And rebalancing, as Elvis points out, is basically to keep you back in line with this investment policy. You have to remember, we have a fiduciary responsibility that you have delegated to us to manage your money. What does that mean in English? It means we're responsible for adhering to those rules that you present. You don't phone us to make trades. Okay, that's the old days of some broker sitting in a room making a commission every time you transact. That's gone the way of the dodo bird. What we do is we adhere to the policy that you set. Okay, you identify that mix. It really breaks down into 3 key areas. I can be conservative, I can be balanced, or I can be growth. And I don't have to be the same for all my accounts, but I can. In other words, I could be different for some accounts. I could have a tax-free savings account that's for growth, and I could have a RSP account that's more balanced. So I want to kind of go through these 3 major buckets for you. So as you know, we call our most conservative bucket our protection, right? Our balanced portfolio is our pension, and our more aggressive portfolio is pursuit. So protecting my portfolio would be somebody who says, you know, more important to me to make sure that I lose less than I make more. These people might only have 40% of their portfolio in equities, in stocks. Somebody who's running money like a pension, a traditional pension plan, like the BC Investment Management Corporation that runs every major pension in the province. This is your traditional 60% for growth, 40% for income portfolio. The 60% for growth will be things like stocks and alternatives, whereas the income portion will be your fixed income or your bonds. And the third one at the bottom, the third bucket, is growth. This person says it's more important to me to grow, to get more of the upside, and with that will come more variance. So I want to show you visually going through what that means, because I really believe in 23 years of doing this, that most people, if I explain to them that they have a balanced growth portfolio, those are just words. What is this going to mean to me when the you-know-what hits the fan? Okay, so let's think about this annually, not monthly, definitely not daily. Okay, you should generally ignore the daily fluctuations of the equity markets as noise. Okay, but remind yourself this. In the past 21 years, I went back and looked at the data. Even somebody who says, I want you to protect my money, that means they're only 40% stocks. They're going to lose money 5 of those 21 years. So what does that work out to as a percentage? They're going to lose money 24% of the time, 23.8% of the time. Okay. pension portfolio and a pursuit or growth portfolio are going to lose money a third of the time. So 7 of those 21 years. If you are not willing to accept any negative returns on an annual basis, your investment policy is not an investment policy. It's not an investment, it's cash. The only return you can get where your monthly returns are always going to be positive and your annual returns are going to be always positive is cash or equivalents to cash. So a GIC, a high interest savings account, what you also guarantee yourself with those asset classes is you will lose money net of tax and inflation. It's for preservation of your capital, not long-term protection of your capital. So look at it this way. Think of drawdowns and worst possible scenarios. So if we look at this slide, and I know there's a lot of numbers on it, but think about something like the really bad periods of time, the 08 crisis, the dot-com crash, or right at the beginning of COVID. A conservative investor right from January, February, March 2020 lost 12.67%. A balanced investor lost 16.2%, and a growth investor about 19%. What we have to think about from a drawdown perspective is how low are you willing to see your portfolio go in a short period of time before you lose it. You phone up and you say, I can't take this anymore. Now I'm changing my investment policy. That's where you lose money, permanent impairment of capital. The worst possible thing to do. Okay, if it goes to 0, you need a 12 gauge and a fishing rod. Nothing we invest in for you do we have any realistic likelihood that it will become permanent impairment of capital. Temporary impairment, maybe. Stocks go up, stocks go down. We don't put things in your portfolio that could potentially go to 0. So you have to look at the maximum short-term downturn you're willing to experience and see, especially when you're focusing on that in a short period of time. If you're the kind of person that's checking your portfolio daily or checking it every month, and in 3 months you're positive and 1 you're negative, it's normal for you to feel worse about that 1 month of negative than happy about the 3 months of positive. That's human behavior. But as long as that doesn't create poor actions on your part as an investor, then you're okay. This is the next part of the slide is very important to go through the drawdowns for pension. If you look at the year 2000, I always use this as a start date for people because, I started in the late 90s, and when 2000 hit, we had 3 years of negative returns. 3 years. So imagine listening to me say to you, you know what, you're doing fine. Robert, I just lost 10%. Yeah, don't worry about it. The market's down 20. I protected your capital. Okay, 1 year of that, sure. Next year, same thing. Third year, same thing. Tested a lot of people's psychological limits to their investment policy. And what did investors do? They made poor decisions, quite often changed their investment policy and went to cash. Not my clients, thank goodness. But if you started in April 2000, if you look at the slide here where it says rank number 2, and you went to the end of September 2002 in your balanced portfolio, you lost money for 2 years and 6 months. That's how long you were down. It started to recover by December of 2003 for a year and 3 months. But your dollar was less than $1 for 3 years and 9 months, with the worst drawdown you saw being 24%. So this is why I use a 3-year rule. 2 big events, right? The 08 crisis and the dot-com crisis. Now look what's happened recently. A lot of people that are investing now weren't even around to invest in the 08 crisis. So they have the attention span of a gnat. I mean, it boggles my mind watching people cross the street now. Very important task that you might perform that could cost you your life if you're not paying attention. And what are they doing? They're looking at their phones. So it doesn't surprise me with investing that people today are so short-term focused. Realize that if you're a true investor, even in a balanced portfolio, you need to keep like a 3-year rolling average return expectation. So let's look at portfolio returns if we start at the worst possible time. So if you go all the way back to the year 2000, okay, you had the worst timing ever. You put $100,000 in. Look at that initial balance up top. 3 different levels of portfolio: conservative, balanced, or growth. Okay. The final balance of each is very similar. Okay. The worst year is way worse for the growth portfolio, almost double the short-term variation for almost no increase in your compound average growth rate. Why are you showing me this, Robert? This is kind of scary. What it shows you is if you happen to have the worst possible timing, then being a conservative investor, if you're really, really bearish and you think things are going to heck in a handbasket over the next 5 years, then there's no real reason to be a growth investor. Now, we don't believe that. Okay, we don't believe we're on the cusp of an 08 or a 2000. But if you did, you can still make a 5 to 6% average return, but you're probably better off doing that in a portfolio that's 40% stocks versus 75% stocks, because you're going to get half the short-term variance. So again, if we're at the worst of possible times for the next 5 years, then you're probably better off being in our more conservative allocation to equities. We don't believe that, okay? But this still supports a 5% withdrawal rate. Okay, so if you said that and you said, you know what, I just retired, I'm really stressed out about what's happened over the last little while, reduce your portfolio allocation to equities. Not a good time to do it potentially, but if it helps you sleep at night and helps you stay invested for the longer term, that's the point I'm trying to get across. If you're looking at periods of time as under 5 years, that's short term. What's going to happen in the next 5 years? That's a short term period of time in the equity markets. Short term is not daily, monthly, or annually. We have very little idea what will happen in the next 12 months. In January 2020, we were not really sitting around thinking, I wonder if I'm going to end up in my, house for the next 6 months, not even being able to go to the grocery store and not being able to go to the office. Nobody was really thinking that. 2 months later, we were living it. So think about this. If you take rolling periods of time, okay, one on the far left side of the screen here, 1 year, 3 year, 5 year, the average return for a protection asset mix over any 1 year period, the average return is 6.39. But look at the variation. This is what we talk about by risk. When we say risk in your portfolio, what we mean is how much variation can we handle? Okay. If somebody says I'm medium risk, nobody knows what that means. It's the stupidest question ever. I don't even know why it's on an application. It should be quantified. If your portfolio drops 24% in the next year, what are you going to do? Well, I don't know. Hopefully I'm not going to do anything. But if I said, I'd panic, I'd sell everything in the next year, well, guess what? You should be in cash. Because you have to go out to 5 year or 3 year periods before you can get that risk, that rolling 5 year period, before you can get that risk down to where it's highly unlikely you will lose money over that period of time. If you look at a balanced portfolio over any 5 year rolling period of time, look at the low, 0.79, basically flat. So that means the worst you'd ever do in a portfolio that's managed like a pension plan over a 5 year period is break even, right? Even if you started in 2000, even if you started in 2008. So remind yourself that if you're a balanced investor, if things go really sideways in a year, somebody could say to you, you're down 34%, but the market would be down 50 to 55% in that period of time. And that's a calamitous pullback. Okay, identify for yourself what's the biggest drawdown you could handle in a 1 to 3 year period of time. This is it visually, right? You can see the blue line is our protection asset mix, say 40% stocks. It gives you much less of a drawdown and it recovers quicker. Why? Because it's giving you less upside. It's less invested in equities. Remember, equities means stocks. We'll buy stocks for you in 3 ways. We'll either buy an index that tracks a whole basket of stocks, we'll buy you a company directly, or we'll hire one of the best managers we can find in North America and put them in our growth fund. So 3 ways you get exposure to the stock market. But in that part of your portfolio is meant to give you the stocks, more of the upside of the stock market and all the downside. So if stocks make 10%, we're expecting our allocation of stocks to make 11 to 12. Okay, if you were all stocks. But most clients are not all stocks. We've got it's like you've got the gas on the car and the brakes on the car. Okay, the gas, that's the equity market. That gives you all the upside. What you would like us to tell you is that we could build you a car that can go 110 and doesn't need brakes. That car does not exist. Eventually it will crash. So this is where you see things like non-fungible tokens, meme stocks that are garbage, Reddit boards with people that live in their parents' basement suites trading stocks. We manage $600 million nearly. Okay, our job for you is to give you as much of the upside as possible without losing all your money. You must be willing to stick to your investment policy for periods of 36 months. If you say, here's $1, I want to be growth, but I might want it all back tomorrow and I don't want to lose my money, that doesn't exist in an investment policy. Remember this, the biggest thing you will do is react to short term. Everybody has a plan, as this gentleman once said, gentlemen, I use the term lightly, until they get punched in the face. Then you better stick to the plan that you had in the first place. And recently, we've started to get punched in the face a little bit. If you had to ask me going forward, do I believe we're going to average the same returns over the next 3 years that we've averaged over the last 3 years? 100% unequivocally no. Okay, now I don't mean to say that we will lose money, but over the last 3 years, even the balanced portfolios have averaged over 7% a year, sometimes close to 10% a year over the last 3 years. You should expect 5 to 6% average returns over the next 5 years, with variance as much as 10% negative. If we lose 10%, it's because the markets are in the short term down 15 to 20. And we've seen this kind of pullback. So I will leave it there and open it up for questions. Repeat my last statement. So what I was suggesting is the last 3 years, we've had a period of time of growth, most of that funded by the Federal Reserve, very low interest rate policy, easy money, okay? Loosening those restrictions still will bring growth, but I do not think we're going to have the same returns over the next 3 years that we had over the last 3 years. So anticipate returns on average over, say, the next 5 years to be closer to the 5 to 6% range, with your annual variance being as much as a loss of 10 to 15% in one of those years. Now, if that happens, that's our worst case, right? If we're down, if your balanced portfolio is down 15%, it means the stock market's down 30%. Now, Elvis might not agree with that, but it gives us the caveat of saying that's the maximum variation you'd ever expect. Okay, we would not ever expect our pension portfolio or even our growth portfolios to be down 30 market level of risk. Do you want to take that one from Darren, Aaron? And then I want Elvis to answer Gary's because I'm about to.
Sure. So is there any hesitation to dump more money in the accounts, or is it business as usual? Okay, I think I understand, meaning that are we getting cash? If cash is coming into a client's account right now, are we hesitating whether to put it in? I would say no. We're not hesitating right now. We've seen a lot of, good amount of decline. Can it go down more? Yes, absolutely. We can't time the bottom exactly, but we also don't know in the short term when it's going to start to go back up. So we've seen a bit of a discount now. We're putting it into the portfolio. And if it does go down, as we showed you, we would rebalance the account again and take advantage of the dips and keep buying more. And if it does go up, then we're happy we got it in. As we said, it's difficult to time the market to exactly when to put it in. So with the RSP deposits, the TFSA deposits, everything that's coming in right now, we are actively deploying that cash into our models and investing it on your behalfs.
I would say too, I would add to that that the issue, Darren, too, is if it's hesitation on your part, if you're putting $1 into your portfolios with us, always remember you're putting that dollar away for a 3-year plus time horizon, right? You're not, and it's not all going to go into the equity market. So if you're a 60-40 person, 60 cents of that's going into stocks, 40 cents of that's going into income, right? If, as Elvis showed you, if the equity markets happen to drop a bit in the short term, we'll sell some of the fixed income, we'll buy more stocks. Your job as the client is to be comfortable with the asset allocation you've chosen. If you're hesitant about adding it, it should be because you think, oh, I've got this dollar. This isn't for the long-term side of my portfolio. It's for the short-term side. Your short-term side can be in a tangerine account or in your bank account. But if it's TFSA, RSP, or long-term portfolio, and you're comfortable with your investment policy risk that you have, you should put it away into those things. Elvis, can you talk about all the great things we've done on the fixed income side with the Steadfast fixed income, or just the income side of our portfolios in general?
Yeah, sure. So as you might know, we launched the Steadfast Income Fund last June of 2021. It's doing really well. It's actually outperforming the fixed income benchmarks. So Gary, with regard to what are we doing to counter this increase in interest rates, I sit on the investment committee of the Steadfast Fund. There's 4 of us on it. And we actually had a meeting today, and this was a topic of discussion. So for one thing, the fund yields about upwards of 3% on an annual basis. So that yield kind of protects, it gives a good downside cushion in the event of the fund bouncing around a little bit. But more importantly, when you talk about fixed income, you talk about something called duration. And duration is the extent to which a fixed income security will react to an increase in interest rates or a decrease in interest rates. So in very broad terms, when you have a risk of rising interest rates, you want duration to be a little on the lower side. And conversely, when rates are going down, you want duration to be as high as possible. Now, in the case of Steadfast, the duration for the fund as a whole is about 5 or 5.5 years. And this compares to a duration of about 7 to 8 years for most of the fixed income benchmarks. So the point is that this is really good positioning by the fund managers who are in the Steadfast pool. And we have every confidence that they will manage the funds that they are looking after very actively as rates start to rise. I hope that answers the question.
I thought it was a very comprehensive answer, Elvis. One of the easy things to point out too for people to remember with both of our funds that have been launched, with Platinum and with Steadfast, what we did for you is we took all the best equity and fixed income managers that were in many cases already present in your portfolios, and we wrapped them up into these funds to allow us to go to them and get discounts for you on the management fees. So it's a lot of the same managers. In the case of Steadfast, we added a few managers that we didn't have. They're some of the largest bond managers in the world. PIMCO, Phillips Hager North, Canso, 9 Point, Cortland. These are companies you generally wouldn't have a lot of access to as a retail investor. So the way I like to explain those two pools for you is these are run just like a pension would allocate. We have such a large pool of capital now, we could go to these managers and say, hey, we want the same discounts as those pension plans are getting. As a retail investor, you couldn't get those before. But so because we launched these pools, we were able to negotiate these scalable discounts and to aggregate some of the best managers in there. So instead of us just owning a bond ETF, like Elvis said, an index that just tracks all the bonds, we've got active managers in there daily selecting the bond mix, and we allocate the capital between those different bond managers.
Just to add on the fixed income side, we also invest in, which I'm sure a lot of you are aware, the Antrim Balance Mortgage Fund, which is tied to mortgage rates. And as interest rates rise, the mortgage rates will rise as well, which will provide more yield and a higher return on that portfolio as well. So if you look over history, as interest rates has rise, the portfolio has actually gone up and performed better. So that's a good hedge against rising interest rates as well.
Exactly. Any other questions? Don't be shy. I think maybe people liked it better when it was a private chat. At least you're not seeing all the faces. It's not like school where, you're that kid putting up your hand. There's no harm putting up your hand here. I guarantee you some of the other kids have the exact same question. we'll stick around for a couple more minutes here, but I would reiterate that if you've got additional questions, please reach out to your lead advisor or to Elvis or any of the other associates on the portfolio management team. We're here for you. You know, we thought the timing of this would be fortuitous because the markets have been very volatile. We're really proud of the fact that we're giving you a lot less of the downside. Look, it's really easy to get all the upside of the equity markets. You just buy the equity markets. But once you've got $1, you know, most of our goal is to preserve some of that capital, right? So taking all the risk of the equity markets rarely makes any sense. And the time it makes the most sense is generally the time nobody wants to do it.
March 2020,
Exactly.
08, 2001.
Yeah, I always say to people, look, if you're trying to time it, really good question is to ask your advisor what they're doing with their money. Never trust a skinny chef, right? Mm-hmm. That's my rule. So if it's really bad, you know that all of us, every single time those bad events have happened, going back to 98, that's when I'm definitely okay to go more all in, right? The worst period of time is when most of the best sales occur. 10% corrections happen pretty regularly. It's the 20% bear markets that are the really juicy times, right? But guess what? The opposite happens. People get what's called recency bias, right? Human behavior believes what has happened in the past will keep happening. Aaron and I joked about this quite a bit, and same with John. Like when the markets were really great in last summer up into the fall, everybody's happy. No, you know, you get all these positive statements in January. You're going to get your statements in a few days probably, and almost every single person should see that they're down in January. But what you have to ask yourself, if I'm down 2 or 3%, that means the markets were down 5 or 6, right? Benchmark your performance. Benchmark it against the volatility you're comfortable with compared to the equity markets. But you have to be realistic. If you say to your advisor, hey, I want to get all the upside of the stock market and none of the downside, he or she, none of us can do that. Well, what we can give you is more of the upside, but with a lot less of the downside. Elvis, can you take the oil question?
Which one? The one from Bill?
Yeah.
Yeah, sure.
That's a tough one.
That's
why I gave it to you.
What's that?
That's why I gave it to you. It's a hard one.
No problem. With oil, I think we are, within striking distance of that $100 level that's psychologically extremely important. And if you look at it in the past, anytime oil's gone over $100, there's always been talk of a potential recession and so on. I think, that's not likely to happen in this scenario. There are reasons why oil is going up so much, why it has gone up so much. One of the main reasons is that it was in a very, very severe bear market for 5 years, starting from 2015, 2016, right up to last year, in fact. And as a result, there was very little money put into oil infrastructure, into pumping out oil, into drill rigs. And that's having an impact now. But in the oil market, there are counterbalancing phenomenon. For example, if oil from Iran comes onto the market, if OPEC gets together and decides to open up the spigots, if fracking takes off again in the US, as it is, that puts a natural kind of cap on oil prices. So is it possible that oil could go to 3 figures to $100 per barrel? It's quite possible. But is it going to cause a severe bear market in the equity market and in the global stock market? I don't think so. So I think oil stays in a range of maybe $70 to the downside, $90, $100 on the upside. But that's probably where it's going to range for the next 6 to 12 months.
Excellent. Darylyn, I think Ryan would have to answer your question about your investment strategy. Yasmina Fiera Comox, So I think you're talking about their private equity, agriculture, private equity, private credit. I mean, our major two we call alternative investments that we hold right now. As Aaron mentioned, we've had Antrim for many, many years, one of the largest holders of it for our clients in BC. And Rise Properties, which I actually personally had gone down and checked out all of their operations, has been great for us as investors as well. Those are our two most alternative, I guess, holdings, plus a hedge fund. We haven't implemented any direct private equity, direct agricultural or private credit holdings. We continue to monitor a lot of these investments. A big criterion for us, and Elvis can clarify this as well, though, is quite often liquidity. So if we buy into some, quite often a lot of the private equity investments require illiquid constraints, meaning it's very difficult for you to get your money out if they're gated or if the redemptions are closed. And quite often we require that liquidity for our clients. Would you add anything to that, anybody? EP?
Yeah, sure. I think, like Robert mentioned, Yasmina, liquidity is extremely important for us. We prefer funds that settle at the latest by a week. Most of our investments settle on a daily basis, but there's one or two funds that probably settle on a weekly basis. But beyond that, it makes life really difficult for us. And in the event of a redemption, we want the money. We want a client to get the money ASAP. You put in a redemption request. You don't want the money to come to you next month. We'll do our best to get it to you in 3 to 5 days. So liquidity is extremely important. But that said, if there's an investment that's really compelling and that requires us to be there for a little while, and if it needs us to lock up our funds for a bit, we might consider it.
The last thing to consider is some of these types of investments also get classified as high risk, which you'd have to have that on your, through your KYC, your paperwork, your risk tolerance, your IPS will have to kind of incorporate that as well.
They don't usually lock in, Yasmina, for 3 to 5 years. It's generally, some of the more illiquid ones are an annual redemption, for example, which again, we will, all of us will continue to monitor how we can potentially hold these in a pool, because if we have a small amount of illiquid investments in our pools, there's other investments that we could liquidate to give you that capital if it's required. But directly when you hold these at an individual level, like right in your TFSA or right in your RSP, the problem is if you happen to need that money, those investments can be illiquid, generally for periods of, I've not seen too many 3 or 5 year lockups. Have you, Elvis? That tends to be more development contracts, not private equity deals. 3 to 5 years, yes, would be if you're getting together with developer, say, that's going to build a townhouse complex, and they're, it's not to come the development stage, the construction phase and the selling phase. But a lot of these private equity companies that are looking for retail money, longest we generally will see is a year. But even that, part of our pooling gives us a lot more control of as a portfolio manager to have maybe a small sliver of those, pools that we're managing, which are in the hundreds of millions now, where we can say, we might be okay with taking 5% of that. So for example, in the Platinum Growth Fund, we've got an infrastructure holding, which tends to be less liquid. That one happens to be more liquid, but sometimes direct infrastructure investments are less liquid, and we might have those in a pool. Okay. John, anything to add?
I've been loving this.
I know.
This is great.
I was just trying to put you on the spot. I was like, John, you got a question.
Thanks for coming.
Yeah.
You're welcome. You're welcome.
No, to everybody, you can say thanks. Anything to add? Thanks for coming. Have a great day.
I just want one of John's clients to ask a very difficult question for John.
Oh boy. Okay.
Not just about how nice his hair is.
That's a difficult comment, not a difficult question.
Sorry, yes.
Yeah.
It doesn't appear like there's many more questions. We're going to record, this will all be recorded, and we should have the link. Aaron, do you recall how long it takes these links to get produced by Webinar Jam once we are finished?
Not long.
Not
It
long.
could be ready by tomorrow.
Okay. Yeah. Okay, great. That's good. Once we have it, if you need a copy or we'll make that copy available and send it out to people. Usually it gets posted right on our YouTube channel. So if you really wanted to look at our YouTube channel, just put in Luft Financial YouTube. That reminds me of one thing I wanted to say. For those of you that are on Facebook, we have a Facebook page for Luft Financial. So if you could sign up to it, we post everything on there, and we post a lot of regular articles that we find elsewhere, as well as the ones that any of the team members write. So if you could follow us on Facebook, you can always find a lot of the information on our website. But if you're on your Facebook feed anyway, instead of having to go to our website, it's probably easier. So follow us on Luft Financial's Facebook page. We'll get those videos up on our YouTube channel. I think that's it. Anything I missed, guys?
Nope.
I don't think so.
No? C'est bon? Okay. Well, thanks everyone for joining us today. We hope it was informative, and please reach out to us or directly to your advisor if there's any topics you'd really like to see us chat about, so that we can present more of these webinars for you. They're very well attended, and most of the time people give us pretty good feedback, so we appreciate it.